Welcome to TheoTrade. This is Don Kaufman. It's April 12th, 2019, and you are watching the TheoTrade Weekend Update. Well, we got another week in the books, and this past week was a rather docile week in terms of trade. What do I mean? Well, we had Monday, we had Tuesday, we had Wednesday, we had Thursday, which we saw absolutely nothing. I mean, for the most part, trading on an intraday basis in a marketplace that was massively unchanged doesn't exactly do it for me. And then, of course, here today, April 12th, the S&Ps took off a bit to the upside. But net, what really happened on the entire week? The S&Ps closed 15 points higher. I mean, listen, the week started specifically at 28.92 and ended at 29.07. That's specific to the SPX. Nevertheless, a 15-point move to the upside doesn't necessarily do it for me. But again, the theme of this weekend's update is, again, docile market. Is that really going to last? And we're going to look at a couple of really specific areas to, in an effort to really determine if some of this this market, docile nature is effectively going to last, or are we about to see a little bit of, froth to the upside and some volatility then to effectively emerge. And I'll explain precisely what I mean here momentarily. The next point I want to make here, before we actually jump into a couple of the charts and a couple of the option chains, has everything to do with the S&P futures. So a moment ago, I was actually, talking about the SPX and again, this docile move to the upside. But let's talk about the S&P futures, because whether it was Monday video or even last weekend or the Wednesday video, I talked about specific gravity points. Those are levels, okay, that the marketplace has been drawn to and continues to be drawn to for, well, quite a substantial period of time. And if you take a look at the S&P futures right here, right now, and we'll look at it momentarily, but if you do take a look at those, where are they at? 29.11, which is effectively one of our gravity points. And again, we talked about it ad nauseum that we expected the marketplace to gravitate specifically to 29.11 inside of the S&Ps. And that effectively, we really had to kind of check that box before we could kind of move on in the markets. Well, congratulations, we can check the box. Now we've hit 29.11, and we've ultimately halted there to think about it for the weekend. All right, so there's point number 2. Moving right along over here, let's talk a little bit more about specific sectors, all right? I've been talking extensively about the bond market. The bond market is driving the financials. Well, a couple of things happened today. Number one, we had a few financials that had earnings. What had earnings? All right, JP Morgan and Wells Fargo. JP Morgan pretty much knocked it out of the park, right? Their earnings come out, the stock is up and up substantially. It actually took the entire financial sector to the upside. But at the exact same time, Wells Fargo also had earnings. What did they do? Bombed big time on the conference call. On the conference call, they talked about, net interest income being down anywhere from like 2 to 5%. And Wells Fargo, well, that's a chart worth looking at on an intraday basis, because they took the stock down quite substantially, again, on an intraday basis. Now, the reason I'm actually bringing this up, this doesn't sound like, broader market kind of discussion that I typically do, but the reason I'm actually bringing this up in this video portion before we jump into the charts is very, very specifically, well, for this. The rest of the banks, and some of the big banks, are going to be out Monday, Tuesday, right? So there's more bank earnings coming out bright and early on Monday morning. We're going to hear from a few of the more big banks, and I'll display that again in a moment over here. But the reason I'm mentioning this, if you look at Bank of America and Morgan Stanley, do you realize that they finished today's trading session up 4%? 4%. Did they release earnings? No. What have they done for us lately? Absolutely nothing. So, lately it's been the bond markets that's been driving financials. Here, we're actually on a wing and a prayer that's driving these financials. The assumption is that JP Morgan financials, all right, and their balance sheet is, what is it supposed to carry over to Bank of America and Morgan Stanley? Could actually be some great opportunity in trades coming on Monday and Tuesday, because I would fully anticipate, listen, between Bank of America and Morgan Stanley and Goldman Sachs and everybody else that rallied in the sector today, somebody is going to bomb, all right, in this next week. That's how financials work. One firm is on one side of the yield curve and the other firm's on the other side of the yield curve. What that effectively means is, like, JP Morgan traded on the right side of the yield curve. They did well. You may hear from somebody like Bank of America, whoops, wrong side. It's like pulling the carpet out from under them. You got to keep that in mind. All right. So with that, again, you look at these moves and it's intense to the upside, and you realize, all right, the marketplace isn't even listening right now. Okay. It's pretty much one financial did good, so we're going to buy anything at any price. Right. And we saw that throughout much of the market specifically today. Now, continuing on with this idea of sectors over here, we also had the tech sector relatively weak. In fact, some big tech stocks, including Amazon and, Apple was up mildly, but Amazon on the week was relatively flat. Again, we'll look at a few tech stocks because tech is weak on a relative basis. Healthcare is weak, really weak on a relative basis. There's some substantial size sectors that are weak on a relative basis. This morning also, this Friday morning, energy kind of took off to the upside, specifically on a deal that was done, and it weakened throughout the course of the trading session. So again, a lot to discuss on that particular front as the markets are seemingly overreacting. Now, to kind of finish that theme, and then we're going to jump right into some of the charts and some of the trades, this theme of like overreaction, pay attention very carefully and feel free to do some of your own homework on this one. China. Let's talk about China for a second. Overnight, Chinese had some data come out. Now, Chinese, they're having data come out constantly over here. We've heard like CPI reports. We've heard, it goes on, different sentiment reports. Bottom line, PMI reports that came out earlier. Okay, there was actually some trade data that came out, import-export type data that came out in the overnight session. And the S&P futures took off to the upside on that Chinese data. The irony of that is, first of all, the Chinese data, it was a little bit better than anticipated. But the Chinese market didn't finish higher. It actually finished lower. The S&Ps, though, didn't matter. Okay, didn't matter what that data was going to be. The marketplace isn't listening to some of the news that's effectively coming out, right? And that's one of the signs, if you will, when I'm talking about this docile market. Things are on the move right now, and you need to be aware of that. So when we're asking, how long is this docile market going to last? Well, again, I'm going to get into some specifics here momentarily, and you're going to find out, most likely, not very long in this specific range. With that, let's get to it. We're actually going to talk a little bit about some strategy, some allocation technique, and again, some very specific trade opportunities that kind of exist right here, right now. With that, let's get to it. Let's get to some of the charts, some of the trades. To the charts and trades we go. All right, before we go too detailed into any individual stocks or start talking about individual sectors, allow us to focus for just a moment on the broader marketplace. And in this case, I'm going to use the S&P 500 E-mini futures. Again, it's just representative of the S&P 500. Again, not everybody necessarily trades futures, but for the S&Ps, I think this will work out great. This discussion isn't so much about levels in the S&Ps as it is about allocation at this point in time. One of the things I think that's really kind of an underdog that isn't typically discussed inside of markets is, a week like this past week, and just going to zoom in for a second, like this past week, as I said, here's Thursday, nothing. Wednesday, oh, we almost moved. Tuesday, there was a sign of volatility, but net, again, Monday, Tuesday, Wednesday, Thursday, it was absolutely dead. We pop to the upside and come right to this gravity point and sit here. Again, this is something that we even discussed earlier in the week, but with such lack of movement in the last couple of trading sessions, as I said, this is going to be a discussion about allocation. You're like, well, how does lack of movement, relate to allocation? We're in an extraordinarily tough spot right now. In the overall marketplace, a tough spot. And every stock that you trade, relates to the tough spot, that the S&Ps are in. So what's the tough spot? The tough spot is simply this. There's your S&P futures. You can open up a 3-year chart. I don't care, how long you want to open it for. We're a stone's throw off the all-time high. Now, listen, again, we've been here before. Obviously, we've been here before, in the not too distant, past over here, where we broke just above, again, this 2911. If you allocate right now, it doesn't matter whether you're looking at this being long or short. By meaning, like, if you want to get bullish over here, great. You want to get bearish over here, great. The problem has to do with, in getting bullish, come on, we're near an all-time high. If we do break out to the upside, but yeah, if you're going to get bullish, maybe you wait for that breakout to the upside, in effect, to get bullish. If you want to get bearish, well, if you want to get bearish, sure, I've got some bearish positions on right now. But at this point, and I have bearish positions on, but at this point, I don't want to continue to allocate until I have to play like wait and see. But the bearish positions I have on, one of two things is going to happen. Either they're going to work and we're going to go down, and I'm going to elaborate upon that in just a moment, Or we're going to come up here, we're going to break the all-time high, markets are going to get frothy to the upside, then we come down. But if we do have that breakout to the upside, wouldn't that provide me better opportunity for some of the stocks that I'm looking at, okay, in effort to get short? And I'm going to, again, show you a couple of sectors here. I'm not necessarily, okay, saying, let's short the S&Ps outright. Not at all. I am very target and sector specific. I'm very stock specific in the areas that I'm currently shorting. Okay, I am not currently in an overall S&P futures short position at this current juncture. Now, with that, okay, now let's actually zoom specifically into the S&Ps and talk about, again, we closed right on it, 29.11 to a T. Now, this happens to be a gravity point that we picked up some time ago. Again, there's another 29.11, and it was a really critical point to the upside and along the way. Now, again, if I zoomed out for a more substantial period of time, the first time that we obtained the 29.11 gravity point was back here, okay, in the, again, August and September timeframe of 2018. And it became, again, a very critical level where we ultimately traded in and around it. And the reason I'm bringing this up, okay, we traded in and around the 29.11 handle, again, from late August all the way until we ultimately into early October when we dropped into the volatility box. Again, talk about some docile trade. That right there was some docile trade, but it was vastly different than what we're seeing right here, right now. And when I talk about like, well, what are we seeing right here, right now? Again, some fairly wild sector rotations. And I'm going to bring up some sectors specifically here momentarily, but the financials, the financials have been taken completely out of action, right, for almost the last 2 weeks and have a burst to the upside. Now, is that burst to the upside in the financials? Is that due to the fact that the bonds backed off? By the way, quite frankly, I am really surprised the bonds actually did back off. At this point in time, I've been looking for the bonds to rip back to the upside. All right, a little bit of a duck and cover. They're not. They backed off today, and they did back off on some decent size volume. That's something we haven't really seen inside of the bonds. So the bonds, backed off. What does that do? Helps the financials. Okay. Meanwhile, at the exact same time, out comes, of course, JP Morgan. JP Morgan closes up 4.7% today, okay, and moves double the expected move. At the exact same time that occurs, again, Wells Fargo, this is what I was talking about with some intraday trade. Ooh, you better watch out for those conference calls, all right? The interest margins were mentioned in the conference call, and the stock, which was up quite nicely, absolutely tanked on an intraday basis. But it was exciting. Did that pull the market back? Actually, it did. It pulled back the financials for a period of time, but the financials actually still paved the way higher. The point that I was saying, and again, this is when marketplaces get extreme. Take a look at Morgan Stanley. Take a look at Citi, all right? Take a look, again, Bank of America in here. I'm just highlighting a couple of the financials. Up the screen, Goldman Sachs, okay? What did Bank of America do today? What did Morgan Stanley do today? They didn't do anything. In fact, take a look specifically at Morgan Stanley. I'm going to zoom out on this, and the reason I'm spending some time on here, people, there's going to be opportunity here. There's going to be opportunity because there's more banks coming out with earnings. Again, these things are up like 4%. If they don't throw up ridiculously good numbers, what do you think the marketplace is likely to do to this sector? So we're coming in to next week. And by the way, next week, it's a shortened week. All right? We only have to trade Monday, through ultimately what? Thursday. Good Friday is coming up, and markets are shut down on Friday. So expiration Friday becomes expiration what? Thursday. Nevertheless, in the SPX itself, and I'm actually going to take you into something completely different in the SPX. Normally I'm looking at, the chart, the expected move here. I just wanted to show you the expirations themselves. Ultimately, what you're looking at, again, a Monday expiration, $13 move, right? This is one of the lowest implied volatilities that we've ever seen. Take a look. The implied volatility of the individual options, it's all the way down to like 4%. It's nothing. It's like 4 or 5%. And yet there are earnings coming out of some major banks on Monday morning. Then you start looking further out in the week, 8% implied volatility. Last but not least, by the way, there's 2 Thursday expirations. This is a primary expiration week. There's an AM Thursday expiration, AM settlement. And there's also a PM settlement. The PM settlement, we're only looking at a $27 expected move for the SPX for the entire 4-day window. All right? So what's the market saying? It's saying dead. Okay? I'm going to counter that. I don't believe it. I don't believe it because the XLF, okay, and the financials, they're not at an 8% implied volatility. They're at almost a 22% implied volatility. All right? What do I anticipate? These marketplace, this thing could be a rockin'. And if it's, again, if the financials are going to be moving, don't you think that's going to like reverberate into the S&Ps? So as I said, I'm going to look for some opportunities this week. And one of the opportunities, again, specific to like, this next week of trade, I want to be a net buyer of options, especially on an intraday basis. Volatility this low. Come on, you even have like Netflix coming out with earnings, all right, after the bell, apparently on Tuesday. And somebody, okay, isn't going to knock it out of the park. And when one of them falls flat on the face, it's going to create a lot of opportunity. And the opportunity, why do I keep talking about a stock falling flat on its face? It's because the volatilities are so inherently low, okay, that if you buy an option and the market does tank at all, they'll explode the volatility out. And that volatility is just going to carry you, okay, as a trader to entirely good places. Just think about that for a second. Now, we talked a bit about bonds, a bit about financials, and again, some real opportunity, I believe, lies inside of some of the financial stocks. But if you're not into trading the individual financial stocks, then go after the financials themselves, the XLF. Okay, I've been carrying lots of positions inside of the financials kind of day in and day out. All right, let's switch gears, okay, entirely for just a moment. I was talking about news and kind of how news has been breaking. I'll just give you a quick example. I brought up Netflix a moment ago. Okay, you think this is a bit of an overreaction in here? Disney comes out with a streaming service. Now, tons of different streaming services have come out. And Disney streaming services cost Netflix almost, 4.5% of their value. Speaking of overreaction, let's take a look at Disney. Now, okay, I don't hide from this one. I've actually been carrying, okay, a mild but short position inside of Disney. In all fairness, okay, with Disney, I've been in this position for over a year. We've had some spectacular, okay, rolls in Disney. But net, okay, we're upside down after this burst up to the upside. However, I am not short the outright shares inside of Disney. Okay, I use a defined risk, okay, in the money put, which quite frankly saved us substantially. Okay, so listen, if you're going to be wrong, this is the way to do it. But I'm using Disney, okay, in my own position. It's an absolute marquee discussion of number one, why we use defined risk, even if you're going to get long or short. I don't mind you taking directional positions. Go to town. But you got to be right. In this case, we're not right. Okay? But the haircut that we're taking isn't that substantial. You survive. I mean, if I was outright short the shares, yeah, this would have hurt. Moving from what? Close to like 115 all the way to like 130 and change by the end of the close. But again, to me, this is more than just being upside down in a position. This is a marketplace that's overreacting. And as I was reiterating moments ago in the video portion, okay, here happens to be the Dow Jones Shanghai Index. And it's rare that I'm going to bring up a Chinese market in a weekend video. The Chinese market closed relatively flat, not really down, but relatively flat. And they're the ones that had good news. Okay. But the irony of that is when the good news came out, okay, in China, the exact same time, here's what the S&Ps did. The S&Ps exploded to the upside, okay, at 1 o'clock in the morning on the Chinese news. Okay, the Chinese market didn't explode to the upside. Go figure. Again, this thing was very well telegraphed, coming to right to 29.11, which is exactly what we were calling for kind of earlier in the week. Now, the last thing that I kind of want to leave you with, okay, on this weekend's update. Again, there's a lot to think about over here. Happens to do, okay, with strength and weakness in specific sectors. For this, I'm actually going to go to a year-to-date chart. And I just want to show you, on a year-to-date basis, the financials are up about 13%. Okay. It was obviously an extraordinarily strong sector today. I mean, come on. The financials did nothing all week. They burst to the upside. All right. What else do I have? You got to look at tech. You got to look at the QQQ. What did the QQQ do this week? Absolutely nothing. Now, this looks like a little bit of a trend to the upside, if you will. But when you start actually like taking a very detailed look at it, all right, on the week, and again, here's the kind of the week at large. That's kind of where the week started out. And where do we get? Almost nothing in terms of movement to the upside. Big tech, specifically big tech. Now, Netflix, I don't construe as big tech, but big tech, Microsoft did have an up week. Okay. Apple, okay, relatively flat on the week. Facebook, okay, and we can just go tech stock to tech stock and tech stock. Facebook, relatively flat on the week. In fact, hasn't really done much of anything for the last 2 weeks of trade. All right. Amazon is completely flat on the trading week. Google, come on, there's always going to be some odd stocks out. Google, when you start taking a look at this, you're like, okay, it did finish up on the week, but after actually having a little bit again of a down move earlier in the week. So net, monsters of tech are not performers. And to look at the monsters of tech, here they are. This is actually charting the monsters of tech themselves. So technology kind of cools off, okay? Financials come to life. And I've talked about this time and again. The financials, they run this racket, right? That's what's driving the S&Ps. So we have to be careful, though, with this. Again, we're in a really precarious area right now. The financials are just foaming at the mouth to the upside. And there's so much in terms of earnings that are coming out in those financials. And the financials, again, all it will take is a little bit of uptick in bonds. One day this week, whether it's Monday, whether it's Tuesday, whether it's Wednesday, the slightest uptick in bonds, and one of these financial stocks missing their numbers, okay, and the financials are going to come off hard and fast, okay? Now, question is, will technology be able to support the marketplace at that point? And the answer this week was absolutely not. Again, the point that I'm trying to kind of, summarize in this, right, in a marketplace that has been, in this last week, was relatively docile, okay? Even though the expected move next week in the SPX is only $27, I'm telling you, anticipate more than that. Anticipate a little bit of volatility starting to come back. Again, coming into this holiday weekend. It's Good Friday. It's Easter weekend. Expect some volatility prior to that. All right. Not so much because of earnings, because the marketplace is displaying signs, okay, of, if you will, like almost sector confusion on a day in and day out basis. A lot to think about in this weekend's update. I want to thank everybody. Please join us live in the TheoTrade chat room all throughout the course of next week for a couple of trade ideas. Have a great weekend, everybody. Bye-bye.